So Turkey just sold 58 tons of gold in 2 weeks, a gargantuan amount of the precious metal. And it wasn't small selling, as you'd imagine. That's the kind of selling where someone in a central bank definitely didn't fall asleep that week or issue a fat finger mistake. And at the same time, gold is still quietly leaving London vaults, and oil prices are rising fast because of the Iran war. Now, here's the part that should actually bother you. Gold isn't going up. It's falling, and it's falling quite heavily. And if you're watching this thinking, this makes no sense, you're right. You're thinking, what's going on with gold? And that's the question we're trying to address today.
We have a plan, because of the power of our military, where every bridge in Iran will be decimated by 12 o'clock tomorrow night, where every power plant in Iran will be out of business, burning, exploding, and never to be used again. I mean, complete demolition by 12 o'clock. And it'll happen over a period of 4 hours if we wanted to. We don't want that to happen.
It doesn't make much sense. Everything we've been told in terms of economic 101s, in terms of the norms of finance, in terms of safe haven demand, doesn't make sense. But here's my promise to you. By the end of this video, you are going to understand exactly why this is actually more normal than you'd ever imagine. You're going to understand why countries are now being forced to sell gold right now, and why what looks like weakness temporarily is actually setting us up for the strongest bull market known to man in the space for precious metals. So let's talk about it, because you might be surprised where we're going with this.
And naturally, this is, of course, the entire paradox of the entire situation. In fact, in some ways, it's very hard to believe, because on one hand, you have got Turkey and other central banks selling the likes of 58 tons of gold sold only by Turkey in just an unfathomably short period of time of 2 weeks. So in that mechanism, something very, very interesting happens. Turkey expedites the release of its gold from the Bank of England vaults. Now, like me, you might be wondering in some paradoxical way, how is this all occurring when war is on the rise and showing no signs of abatement, denouement or cessation? Oil, at the same time, is also going up, but weirdly, strangely, inexplicably, gold is plumbing new lows, going from 5,500 in a gargantuan sell-off at points reaching 4,100 and only regaining support around 4,500. And you might be thinking, so how on earth is all of this happening with all of these headwinds behind it, and still in some way gold is going down?
This doesn't really make sense moments, or why is this happening the way that we shouldn't be positioned? Why is my portfolio bleeding in a time that I thought it was perfectly set up to exploit and capitalize from this position? But to know when that happens, to know why it happens, to know how it happens, something bigger needs to be understood. The fact that something else is going on underneath the surface, something way more interesting and way more perilous. So let me give you the simple version first. Countries need dollars. They just never have enough, and that's the pure, simple logic of it. So when they don't have enough, they have to sell something to gain those dollars, which means they sell things like gold, they sell things like infrastructure, US Treasury bonds, silver, precious metals. That's it, literally. I know it's not exactly the conspiracy theory that you were all hoping that I was going to expose. It's not the grand moment of aha, the eureka moment where you go running down the street naked thinking, I've learned the truth behind reality. It's just a very boring, very real, very liquidity driven problem.
So here is the most simplistic version of it all. The simplistic way, the 3 steps, let's call it the 3 steps, the trio of explanation, hopefully. So in part 1 of the trio of explanation, we have sovereign nations. countries and nations, they really require one thing. They require a steady flow of dollar liquidity. Because in this paradigm, like in many other paradigms, we have war costs. We have defense costs. We have oil costs. And we definitely also have energy costs. Now, you might see that all of those things are interrelated, but it brings us on to the second thing that is vital, of absolute existential vital purpose and necessity for these nations. So the next thing all of these nations need is an ample supply of liquidity. However, they don't have enough of it. They can't get enough of it. It's an insatiable, voracious appetite, which leads, in these times of stress, to their reserves being drained. In good times, they save up their monies, they save up their reserves, and in bad times, they have to spend their reserves. So the reserves are being drained, and oil is not flowing into the markets or out of the oil producing markets, which leads us on to step number 3 in this entire new paradigm shift in the oil market. In step 3, what do they have to do? They need to raise capital. And just like any other entity, an individual or a sovereign nation or a corporation, they need to sell the assets that they have. Now, later on in this video, we're going to talk about the asset stack or the asset allocation that builds up and makes up this whole portfolio in a sovereign nation and what they can draw upon to raise capital fast. But all we need to really be focusing on right now is that one of the most liquid things they do have to sell is gold. They can sell it fast, they can sell it quick, and they can sell it reliably. It's not a conspiracy. None of this is a conspiracy, in fact. It's just the liquidity of how it all works.
When they don't have enough, they have to sell something to gain those dollars, which means they sell things like gold, they sell things like infrastructure, US Treasury bonds, silver. If you've ever watched markets, like me, and you've thought, why is this moving in the wrong way? You're probably told that no, the markets aren't wrong, it's you that's wrong. Why is it moving in the wrong way? Why is it not adhering to the narrative or the macro thesis or to how it's meant to react in these situations? Well, I hate to tell you, but welcome to financial markets, where logic is actually optional, where logic sometimes is illogical, and where things can remain more irrational than you can remain solvent in a given time period. But in this world, as frustrating as it is, liquidity is God. Liquidity is the only option. Liquidity is all that matters. So let's start with what actually has changed.
Okay, now, so we're going to have to get a bit mathy. The oil shock is going to lead to some very interesting mathematical deductions and realities on the ground. Because when oil prices rise, they force a few things to happen. So let's explain this arithmetically. In our table here, we are going to have 2 columns. We're going to be expressing it as oil prices rising and the extra costs per year and how that really affects countries and economies and therefore the need to raise capital. So let's imagine a $10 increase in the price of oil. That's going to lead to about a $4 to $5 billion extra expenditure for most countries who import their oil. I'm not talking about the self-sufficient countries. I'm not talking about the energy behemoths like the Americas or the Saudi Arabians or the Gulf nations. I'm talking about the nations like the UK or the blocs like the EU or Korea or China, heavily oil import dependent. And this goes up in a linear fashion until, of course, it doesn't anymore when the moves become a bit more existential. So if we keep going down, we can start to see just how critical this becomes in terms of how much extra expenditure these countries are going to have to spend. And we go into the worst case scenario. Let's imagine a $50 increase in oil. It's going to lead to a $20 to $25 billion extra expenditure to these oil poor nations. Now, unlike Netflix, you can't just cancel oil for a month and hope that it comes back with a cheaper incentive price mechanism. You have to sustain it, because in the modern economy, and indeed in any economy, any kind of economic growth is just energy transformed. All of the inputs are energy driven. And that's why when we have a simple graphical interpretation of it, if the oil price trajectory is going up each and every single month, we can probably draw a concomitant albeit roughly inaccurate graph that economic activity is probably going to be suffering in some other way, shape, or form. Not just to mention economic activity, but also consumer sentiment. Prices at the pump really driving people's standard of living down. Their political disposition changing and oscillating, whether it be Republican or whether it be Democrat. They're really unhappy with their political reality on the ground, so to speak. So these are the mathematical realities behind the oil price shock. It isn't as simple as oil prices high today, okay, they're going to be lower tomorrow. These countries and these nations have to plan further out onto the curve than most other entities do. And when they have to plan that way, they have to lock in these prices. And most of them, a lot of them, you'd be surprised to find, is that they actually participate in the oil markets, in the spot market, which means they are paying the price right now. And just because you see on the wires, crude or Brent, and you see it at, I don't know, 120 or 105, that doesn't always mean they're actually getting those prices. Sometimes the prices they're getting are even more volatile when it comes down to the distillation of the different grades of these oils, the different gradations, the different qualities of these oils, the procurement costs, the insurance costs. So now you start to see why this can become very ruinous very quickly.
To make this real, let's contextualize it. For some countries, every $10 increase in the price of oil means about $4 to $5 billion in extra expenditure. Now, some countries can scant afford that. Now, imagine if oil jumps $40 to $50 per barrel. That represents tens of billions. And unlike your Netflix subscription, you can't just cancel it and wait for it to be renewed next month when the liquidity or when the income is flowing a bit more loosely, a bit more freely, a bit more unabashed. So you don't cancel it, you do something else. And this is where our first example comes in, the margin call on a global sovereign level. Now think about this like a trading account. If you're leveraged, I mean, be careful, leverage is a weapon of mass destruction. It works both ways. It amplifies your gains and it amplifies your losses. But imagine you're leveraged, I don't know, 10x, 20x, 5x, and the market moves against you. You're going to get a margin call. And the margin calls at the beginning are going to be email driven, they're going to be notifications, they're going to be polite, you know, your broker's going to be quite respectful. But suddenly, they're not going to be polite anymore. You don't get to wait. You don't get the period, the grace period that you're used to. You have to raise the capital immediately. Then it happens all at once, like the famous Hemingway quote, we went broke gradually and then all at once, all of a sudden. But all of a sudden, these margin calls are no longer polite. You don't get to wait anymore. You don't get to suddenly say, I'll think about it. You need the cash and you need it now. And if you don't have it, what happens? All of your positions get closed out immediately. And if you don't have it, you don't get to participate at the poker table for any long period of time. So the system sells all of your positions. That's exactly what is happening here now, but on a sovereign level.
So this could also be better explained with our analogy, our first analogy, maybe of many. Let's call it the margin call. Now, I know as soon as I mentioned the word margin call, some people's heart rates probably increased, their vascular load probably increased, and their cardiovascular stress probably went through the roof. But we're going to have to talk about it nonetheless, albeit uncomfortable. So we're going to talk about it on two separate levels. We're going to talk about it from a trader level, which is the individual level, the me and you level. And then we're going to talk about it on a country level, on a sovereign state level. So let's first talk from it from a trader perspective. So what happens? The market moves against you violently. Market is against you. It moves against you violently. You're in a position, you're caught offside, whether it's long or whether it's short. And then we know what happens next. Our broker gives us quite a polite warning. Maybe it's not as polite, depending on the broker you have, but the demand is the same. It's you must add funds to keep your positions open, because the broker, however nice they are to you initially, doesn't mean they're going to fund your positions ad infinitum. But if you don't do that, we know what happens next. It's the dreaded margin call. Now, in the margin call, it doesn't matter if your thesis is correct. It doesn't matter if your narrative is correct. So your macroeconomic analysis of the situation was very, very good. It just matters that you need to do one thing. You need cash and you need it now. or your positions are going to be completely liquidated. And what happens in that position? The last death knell of that is that your positions get sold. Now, you might be surprised to hear that this actually also happens on a corporate level and on a nation state level as well. And let's go through it. So on a nation state level, it's not the normal meme stock or the normal blue chip stock that you're trading that's going to get you into a perilous doom loop. It's going to be a geopolitical event. So let's imagine the one we're in right now. Oil prices absolutely surge. They go up in such a short time frame, but with such a great magnitude that the delta is very, very difficult to hedge. And the cost of war are all going to rise exponentially as well. So what happens in that situation? Okay, you don't have a broker, but your reserves definitely start getting dried up. Your reserves are being expended at an increasingly fast clip. Now, their margin call in the institutional or on the sovereign level is going to be in the form of the currency being at risk. The currency now is going to start losing its value for obvious reasons. And just like the broker, the not so polite broker, or the polite broker, who knows if they're a salubrious, scrupulous one, they're going to also demand dollars. But they don't have a broker, obviously. They just need dollars in order to sustain their obligations, their real world obligations, their costs in their nation, their defense costs, their energy costs, their national security costs, all of the things that nation states need. So what do they do in that scenario? And here's the important part. They don't have a margin call or sell their positions. They do sell something, but they sell their reserves asset, their gold. And why do they sell their gold first? Well, listen on, and we're going to break that down granularly.
Let's explain this clearly. Countries are in the same position as a retail trader. And I know that sounds bombastic, I know that sounds nonsensical, but on a big level, on a systemic level, it's exactly the same. Costs goes up. You're going to need dollars, just like the margin account's going to need dollars, just like the leverage account's going to need dollars. They need dollars in the same way that a retail trader needs dollars to sustain and fund their positions. So they have three choices, and none of those choices are
And none of them are fun, so we can get that out of the way immediately. Now, we're going to make a decision tree here. In all of these iterations and permutations of these events, costs all rise in a big way, which we now know means they need one thing. They need an ample supply of dollars. So what happens in those scenarios? We have three scenarios, and none of them are good. None of them are rosy. None of them are ideal. So in scenario number one, in the event that you have a sovereign level margin call, you could let your currency collapse. We'll let our currency collapse for 10 points, please, Clive. It's not an ideal situation, though, on this game show of life, because that means one thing. In that scenario, you no longer exist as a political concern, because it really is political unaliving. They don't want to do that for a variety of reasons. Option number two, if you are so inclined. Option number two means you can burn those dollar reserves. All of the reserves you've been saving up in your balance of trade system, or I don't know, maybe you've hedged it using your tax receipts or the difference between them, and you've allocated them into dollars for an eventuality just like this. You start to burn those dollar reserves. Not literally, you start to sell them to raise capital. But the most interesting one is you sell your gold. And in that scenario, you can get quick cash, you can get reliable cash, and you can get a large amount of cash, depending on your asset base, obviously. Now, there is one big difference here. And the big difference is you're not selling gold because gold is bad. No, we all know that gold is not bad. You're selling it because you need the cash. And that is the real reason you're selling it. In those three choices, the most rosy outcome of all of them is to sell your gold. None of the other ones are palatable. Currency collapse, we can't do it. Burning dollar reserves, we can do it for a while, for sure, but we still need it. We still need our dollars to fulfill global obligations and to have buffers for certain institutional or government level requirements. But we can sell our gold to ready buyers. Who knows? Probably in the East, probably to the unnamed new megalithic country on the rise. Okay, we know who it is. It's probably China. Now, let's move on.
Easiest one here to resolve and solve for is to sell your assets. What's the most liquid, most recognized, most trustworthy asset with a liquid market in the trillions? Of course, it's gold. Now that's why gold is often the first thing to always sell first. So let me slow it down a bit, because I might be traveling at warp speed, but we need to explain this, because this is where most people actually get these dynamics and these understandings wrong, because they're not selling gold because gold is bad, or because the narrative has changed, or because the macroeconomic conditions have changed. They're selling it because they need the cash and they need it yesterday. It's a big difference between the asset becoming toxic and the asset no longer being viable to actually selling the asset because it's the most readily available, most liquid asset out there. It's liquidity first. It's a big difference. So now we've understood retail traders, we've understood margin accounts, we've understood the sovereign level. How about the institutional level? So institutions have to also behave in this market. If a fund suddenly needs that liquidity, if a hedge fund suddenly needs it, if a sovereign wealth fund suddenly needs it, they don't sell the thing that nobody wants. They sell the thing that can find a ready buyer.
So if you're watching these markets, you might have seen the selling and you might have said, this looks a lot like forced selling. It looks like price inelastic, price insensitive, price agnostic selling. But to understand why it happened that way, we need to understand what actually moves these markets. How are these markets actually moving? Many people think the markets move on news-based releases, and they do to some extent. Many people think that Twitter is part of it. But Twitter is part of it, but a very small part of it. The next logical idea would be narratives, macro narratives, themes, capital allocation, big funds. Then we have opinions moving markets. But ultimately, what really decides these markets is forced selling, structural selling. So if we were to assign each of these a percentage weighting, we'd probably find that only 2% of the market moves on Twitter moves. Narratives may make up a hefty 15%. Opinions of really respected people may make up 20%. And then the rest of it is going to really be just forced selling. The rest of it is complete forced selling, structural selling. So yeah, it matters for Twitter, but not that much. Yes, narratives matter. They're more slow moving, but not as much. And opinions, sure, your Stan Druckenmillers, your Jamie Dimons, they all matter. But forced selling is the one that really decides where capital goes. But who is selling right now? Who, where, and what?
I need 50,000
Well, the people
shares
selling
at
right
20.
now, they're not people. They're sovereign nations. They are countries that import energy. They are really desperate right now. And that's why you see all of those countries like Turkey, India, South Korea, a lot of these countries, especially in countries that you wouldn't expect, like Egypt, are even starting to tell companies to close at 8 p.m. and turn off street lights because there's a problem with sustaining energy. And then our next forced seller is going to be someone you might not expect. Dollar-pegged nations.
But we can expand it even further if we zoom out, because this isn't just one country. We're not talking about just one distressed seller. We're not talking about one pariah nation. We're talking about a global system. And this system is made up of a few things. It's made up of people who peg their currencies that need dollars and they need stability. It's made up of dollar-dependent economies all around the world. It's made up of energy importers, and it's made up of countries defending their countries through their currencies. And they all need one thing, and they all need it right now. With no equivocation, with no second guessing. They all need dollars, and they need it at the same time. So obviously, we know what happens in that scenario. The dollar demand spikes.
And that leads me on to my last one. Those are currency defenders, not keyboard warriors, but actual noble currency defenders. They have to spend their reserves to maintain their exchange crosses, because it's very important in terms of their import-export dynamics and their domestic stability as well. So those are the main forced selling dynamics and relationships.
The DXY goes up, the selling increases, the gold drops. It's a vicious loop that keeps going on and on and on. And everyone watching the headlines is absolutely bamboozled and completely confused as to why it's happening, because it makes no sense unless you understand the dollar dynamics, unless you understand the flows of capital.
Okay, now that's all good and dandy, but what actually happens next? To understand it, you have to understand the two phases. And broadly, they can be described as stress versus relief. Now let's discuss what that means and what it actually looks like on the ground. So phase one, we have the now, the existential. the things that seem like they'll never ever pass because it seems so dire. Then we have our phase 2. And the phase 2 is the much sought after, much vaunted relief. How does it work though? To understand it, we need to understand what actually happens in phase 1. As we spoke about before, costs all spike around the world, and especially in your country. Oil becomes expensive because the price of it obviously has exploded. Dollar demand, we know now, is going up. And I hope this makes sense. Dollar demand is surging. It's up, 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 up. Gold is then obviously sold. We now know the routine, nothing new. And obviously the gold price falls. That's phase 1. Now, what happens next? And it might not be as logical towards your thought processes as you actually think. But phase 2 is always the relief. And it's not my assumption. It's just how these markets work since time immemorial. And I know that past is not prologue and history doesn't rhyme. But indeed, it is what we've seen. Eventually, after some time, these things always happen. Our central banks step in like massive superhero saviors. The liquidity becomes expansive. Rates are cut. Money gets printed. Gold reasserts itself. And prices eventually recover. And we're seeing some of that right now. Now, that's not a conspiracy theory. That's literally what happens. It happens every single time, and it's like clockwork. And it makes sense. It's not a conspiratorial thing. It's a mechanical thing. When we see stress, we see central banks, we see liquidity, we therefore see asset prices going up, and then we see the cycle continuing. Every time, like clockwork. Because the central banks, it's their only toolkit. Liquidity is their main weapon. Stress is their main kryptonite, their main weakness, their main bête noire.
So yes, it's confusing. Yes, it's heartbreaking. Yes, gold has been falling. Yes, it will probably find the bottom. And yes, it will most probably make all-time highs again once the resolution of this war is over. But it's not falling because it's weak. It's falling because liquidity is not ample. Liquidity is tight. That's the first layer. That's how it works. This has happened in many, many other conflicts all through time. It's happened in other scenarios of liquidity constraints, and it will happen again into the future, undoubtedly. But here's where things can actually get even more interesting.
So the real root of all of this is derived from pressure. Pressure financially, pressure diplomatically, pressure politically. But the pressure doesn't dissipate. It doesn't go away. It doesn't disappear. So something else happens. You have to think about, where does the pressure accumulate? Who are the weakest hands? Is it the Gulf nations? Is it Russia? Is it China? Is it America? Then you have to think about where the pressure is going to move next. Where is it moving onto? Is it moving into the Gulf countries? Is it moving into USA? Is it moving into the EU? Is it moving into oil prices? Or is it moving into oil prices? Or indeed, the pegged nations? Are these the weakest tools in the shed, for want of a better phrase? Now that we understand that, we know definitely what gets sold first. And we know that it's those hard liquid assets like gold, and then treasuries. But most importantly, we need to understand who actually needs that cash, who needs it and who needs it fast. Because if you see where the pressure is, you see where it moves to next, and you understand what can actually happen. And in all of those positions, in the 1 to the 2 to the 3, is your ability to do something very important, to position yourself accordingly.
This won't last forever. It never does. It's going to resolve itself. Liquidity is going to come back into the system, and you're going to position yourself again accordingly. Let's just hope that you position yourself quickly enough and strongly enough to actually benefit from it in the future. Central banks are going to step in, liquidity is going to expand, money is going to get printed, quantitative easing or yield curve control is going to come back, which, if we're being honest, is the only way that these systems actually function in a debt-driven society. But that's enough from me right now. My name's Justin Banton. This is the House of Trade. Ciao for now.